So the Fed is expected to make their major decision on the Fed funds rate this Wednesday, July 31st at 2 p.m. Eastern. Is the Fed going to cut? Are they going to keep rates the same? In my opinion, I feel like they're going to keep rates the same, and I have some data to back that up. However, you must see this chart here on the NASDAQ and the S&P 500. We are at an extremely crucial level where if we lose this level, we are in for a deeper correction. So I'm going to be giving you my full analysis on the S&P 500 and the NASDAQ, where we are now, and what stocks I'm looking to buy, although I'm going to be making a separate video on what stocks I'm buying for August. And I have a surprise piece of data for you that you might actually enjoy. And if it pans out, will actually benefit you monetarily. So let's get right into it. As I said here, the Fed is expected to make their Fed rate hike decision on Wednesday, July 31st. As you can see here, FOMC statement in 2, Jerome Powell talks at 2:30. Now, as of this moment, as of the time of this recording, the Fed is expected, 96% chance the Fed is expected to keep rates where they are. And if you look at September, this is when there is a 100% chance that the market is pricing in that the Fed actually institutes its first rate cut. And as of now, the market is expecting that the Fed does 3 rate cuts, September, November, and December. That's 3 rate cuts for this year. Now, there could be reasons why the market might be disappointed and the Fed actually decides to institute their first cut in November, but let's not get ahead of ourselves. So if you take a look at the inflation picture right before I show you this extremely important chart that you need to look at, if you care about your money and your investments. But if you look here, you can see that the Fed, or you can see that inflation came in at 3%. This is the lowest inflation that we received since July 2023. And if we look at the month over month data, you could see here that this is the first period of deflation that we experienced since January of 2023. Month over month came in at minus 0.1%. We're not even going to talk about how these figures are calculated, whether these figures are cooked or not. You guys know my opinion on this if you're familiar with this channel. So let's not even dive into that. But what this means is that if inflation continues to trend down, and this is why I don't think the Fed is going to cut just yet, if inflation continues to trend down, then we will be in the 2-point-something% year over year for CPI. And that is what the Fed is looking for. So if in August and September, we do get inflation that is trending down towards that 2%. So if it's in the 2.5% or below year over year, then I think September we are going to get that first rate cut. If not, I don't think we will get that first rate cut in September. So let's take a look at the charts real quick, and I'm gonna let you know what I'm seeing. Now, the NASDAQ had an almost 10% correction, not surprising since the NASDAQ is made up mostly of tech stocks, and we know that stocks like Nvidia, like AMD, like Broadcom, like Apple, like Microsoft, like Meta, all hit all-time highs, right? So it's not a surprise that we are now getting a pullback. Now, as of the time of this recording, we are also in the week of major earnings. We're going to be getting Meta, Amazon, Apple, and Microsoft earnings this week. So I'm going to tell you what I'm expecting here. Now, this right here is holding a major trend line. This is the major trend line that has really been intact since this bull market started. And if we pop open the moving averages, you guys know I don't use the moving averages for day trading, but I definitely use them for long-term analysis because they are actually a pretty good barometer when you are looking at the long term. We are sitting at the 100-day moving average. The last time this happened was in April. The last time before that was November 2023. So if you take a look at this, we're sitting right at the 100-day moving average. This is a very pivotal point. Now, this is why I said that this chart is extremely important. If you're familiar with the day trading models that I use, you're familiar with something called market maker buy model and market maker sell model. I promise you it sounds more complicated than it is, but essentially, once I show this to you, it's going to be like magic because you're going to be seeing it all over, especially on liquid instruments, equities, indexes, etc. But if you take a look at this, we're making higher highs and higher lows. This right here is completing the buy side of the curve. Once we get a reversal, we start making lower highs and lower lows. Now, what usually happens is the market maker sell model goes down to the point of the first area of consolidation that started the market maker buy model. So I'm going to show this to you time and time again. This happens. It doesn't look like it, but if you look closely, let me remove the moving average real quick, and then I'll hop over to the S&P 500. You'll see that the market maker buy model, you can see that here, right? And then it goes into a sell model, and then we go into a buy model, and then it goes into a sell model, and then we go into a buy model. And on uptrends, right? On uptrends, we don't quite always make it to that consolidation level. This is what causes the uptrend, is that we're no longer retracing all the way back down to the consolidation that started that buy model, right? This is why you get higher highs and higher lows, etc. So in this case, because we are in a correction, this is the first 10% correction of the NASDAQ, I believe. I don't think we hit 10% in April, did we? No, we hit about 7.5. So this would be the first 10% correction of this year for the NASDAQ. Like I said, I'll hop over to the S&P 500. So if you lose this level, basically, if earnings come out, the two things that can happen here. Depending on what the Fed, I know that the Fed is going to keep rates where they are, but Jerome Powell's rhetoric is going to be scrutinized and dissected like a medical student working on a rat in the lab, okay? So if he comes out and says, look, guys, we are not going to cut 3 times this year, right? Or September is looking very unlikely for a rate cut, because this is what the market is expecting. If we look at this, as I said, the market is expecting 100% that the Fed is going to cut in September. The market does not like surprises. So if this is what's priced in and a pause in September is not priced in, what happens if Jerome Powell says that it is unlikely that we cut in September, right? That is when the market will likely react and will get a larger correction and potentially complete this market maker sell model. Now, if earnings come out and completely disappoint, that can also propel a larger correction. So Microsoft, Meta, Amazon, and Apple, right? If they come out and disappoint, if they come out and meet expectations, I really don't think that that is going to be market shifting at all, right? Unless they say something on the earnings call that says our guidance, some of those companies don't report guidance, but if they come out and say our guidance actually shows that we're fucked, guys, we're really fucked, then obviously that will also propel a larger correction. But if you take a look at Microsoft, for instance, Microsoft rarely beats the expected move in terms of volatility, right? Because of options trades, there is an expected move in the underlying stock based on how institutions are betting using options. So if you look here, Microsoft does not meet the expected move most of the time. So if it just comes in and reports as expected, most likely the stock is not going to move that much unless, again, it comes in and reports something that is extremely heavy-handed and something that is unexpected, right? And if you take a look at, say, Amazon, you can see here that half the time does not beat the expected move. So we're not dealing with a ton of volatile stocks as it relates to earnings. And we'll take a look at Apple here. This will be the last one that I do, but you get the picture. The options market overestimated Apple's earnings move 58% of the time. So most times it does not move according to the expected move that options traders are betting on, right? So we're not really dealing with extremely volatile stocks here as it relates to earnings. And that's why I don't think these companies, unless they report something terrible, are going to be market moving and cause a further correction, right? If they just come out and report as expected and don't give bad guidance, like I said, Apple doesn't give guidance. Some of these other companies don't give guidance either. In my view, as long as earnings are reported as is, it's not going to cause a huge correction. And the NASDAQ sitting here minus 10% at a pivotal point should be able to hold itself here as long as Jerome Powell plays ball and doesn't feel the need to go ham with his commentary. S&P 500, same thing. This trend line holding really since the beginning of the bull market. Down about half of the decline that we saw in the NASDAQ, so it's down only about 5% from highs. Obviously, the S&P 500 being way more diversified than the NASDAQ. Currently sitting at the 50 moving average. If it does drop to the 100 moving average, it'll be about 6.5%. Again, nothing too shabby here. Now, there's one piece of data that I want to show you that I posted here in the private trading floor. This is a golden nugget. By the way, shout out to the monster day that we had today. We were 3 for 3, had almost a $6,500 day. If you want to trade live with us every single day, I day trade too. I don't just do economics videos. Some of you know that, some of you may not know that. But if you want to day trade with us live every single day, Click the link in the description. Come trade live with me every single day at market open. I day trade futures every single day at market open. We also do swing trade options and stocks as well. But in terms of day trading, I day trade futures. And if you want to learn how to trade a funded account so that you don't have to put up your own capital, and if you pass, you can make money without having to put a ton of your money up, click the link in the description. So this is what I posted today. Here we go. It says seasonality for the SPY, 32 years, August, right? I want you to take a look at this. So every election year for the last 32 years, the month of August has been 100% green. Every single election year for the last 32 years in the S&P 500. So in terms of seasonality in election years, August happens to be the best month. And honestly, looking at the technicals, if I was to marry what I'm looking at the technicals with that, again, as long as Jerome Powell doesn't come out and completely screw us, these technicals actually support what I'm seeing. I can actually see, like I said, the NASDAQ and the S&P 500 holding the trend lines that they're currently at. Now, in terms of what I'm buying, I already sent this out in the private trading floor, but in terms of what I'm buying, I did add some NASDAQ to the portfolio here because you know why? Every time the market is down 10%, I add. It's blind. I don't care what is going on, and you shouldn't either, in my opinion. All this like, oh, but what if Taiwan? Oh, but what if this? What if that? If it's down 10%, I buy. You want me to show you some data? Let me show you some data. Here's what happens if you bought every stock market correction going back, I don't know, 40 years now, right? If you bought every stock market correction, this is the 1-year return after lows. Shout out to LPL Research. The average return 1 year after just a stock market correction, we're not even talking about bear markets here, is 22% after the stock market correction, right? Only one time in 2000 was at negative 1 year after. And I know some of you might be saying, well, what if this time is different? Okay. More money is lost waiting for catastrophe than actually staying in the market. That is an absolute fact. That's not something that I make up. You can research that on your own. There are tons of people from Bank of America to LPL to JP Morgan that can give you loads and loads of data on this. More money is lost trying to anticipate a crash or anticipate a black swan than is made by just staying in the market, or at least being a little bit smart about noticing when the market is down 10% and buying the market, right? And if it falls down another 10%, guess what I'm going to do? I'm going to buy it again. Another thing is, here's the reason why you want to do that. In my opinion, you could do whatever you like. This is not advice. But in my opinion, here's the reason you want to do that. Because when catastrophe strikes, and it will strike, right? It will strike at some point. I think right around the time of the first rate cut. That is the first warning signal, or the canary in the coal mine for me, right? But when the market drops, like say that you bought the highs and you didn't buy corrections. Say that you bought in October 2007. You had to wait 6 years before you saw that price level again. If somebody bought when the market was down, they barely have to wait half a year before they make returns, okay? So somebody that buys at the highs versus somebody that buys at the corrections, the person that buys at the corrections is going to be rewarded a lot sooner and a lot more exponentially. So for me, I've been in the markets for a long time, and I know that every time the market is down 10%, I add to my long-term portfolio. This is not a swing trade. And if you're worried about anything geopolitical or political, there is so much research that shows that geopolitical sell-offs are typically short-lived. So if you're like, oh, I don't know about Trump and Kamala and Biden and all this stuff. What about Taiwan? What about Russia? What about Gaza? If you look at this, geopolitical sell-offs are extremely short-lived. And we've seen some things that are way worse geopolitically than at least as it relates for the U.S. directly. We're not even talking about wars that don't involve the U.S., right? The Cuban Missile Crisis, President Nixon impeachment, the Iranian hostage crisis, the Soviet invasion of Afghanistan, the Iraq War, etc., right? These things are extremely short-lived. They do not last. The market simply does not care about them. It is just an opportunity to add more on a discount. Now, what can be long-lasting, obviously, are recessions, right? And this is why I say I'm monitoring the spread between the 10-year and the 2-year, and the spread between the 10-year and the 3-month. When they both uninvert and when the Fed cuts, then I'll be on high alert and I'll assess the situation from there. But I don't rack my brain about what if this and you know, what if this president gets elected versus that president gets elected. No, that's not the way that I've typically invested. And in my opinion, based on the data that I've seen, those things are typically overblown. Anyway, we'll see what Jay Powell actually says on Wednesday, July 31st. We'll see if we complete this market maker sell model to drop the NASDAQ to that 420 range, and if the SPY completes that market maker sell model, because it is there as well, right? We'll just draw it real quick. But if it completes its market maker sell model to that area of consolidation here, we're looking at around 500, right? But again, I'm not Nostradamus. It's all dependent on some of these things upcoming. Anyway, hope that gave you some nuggets of information that you didn't have before you started watching the video. If it did, give this a big fat thumbs up. If you want to trade live with me every single day at market open, and you want to learn how to trade futures, and you want to learn how to make your own destiny so that even if the market drops, like we took advantage of today, you could still make money. If you want to learn how to get funded, sign up, use the link in the description below. Would love to have you. If not for the day trading, you could stick around for the long-term analysis, my macroeconomic view, etc. All that I put in the trading floor as well. Subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace.